The sun rose crimson over the island nation this morning, an auspicious omen for the latest batch of trade data from the Ministry of Finance. According to the preliminary figures released today, Japan's export engine is revving higher, with outbound shipments rising a robust 10.3% compared to this time last year. This accelerated growth in exports, up from a more modest 5.4% pace the prior month, was largely driven by external demand for high-value products like semiconductor components and automobiles, two sectors where Japan maintains clear competitive advantages on the global stage. Yet, in a stark reminder of the economic headwinds faced by policymakers, these latest numbers also reveal Japan is being buffeted by the punishing crosswinds of a stubbornly weak yen and elevated import prices. Imports surged 16.6% year-over-year, outpacing exports and leaving Japan's trade balance back in deficit territory to the tune of 621.8 billion yen, $4.3 billion. While modestly higher than analysts projected, this yawning trade gap is the inevitable byproduct of Japan's voracious appetite for imported energy and raw materials, coupled with the yen's precipitous slide to a 38-year nadir versus the dollar last month. As a resource-poor nation heavily reliant on foreign suppliers for vital inputs, rising import costs erode more and more of the gains from increased export volumes. This two-headed dilemma, where a weaker yen juices export competitiveness but simultaneously inflates the price of all imported goods from energy to food, lays bare the conundrum confronting the Bank of Japan as it seeks to engineer a durable, self-sustaining recovery. On one hand, the central bank understandably welcomes the tailwind that a cheaper yen provides manufacturers and exporters. When translated back into yen terms, every incremental sale abroad yields greater repatriated revenues, bolstering corporate profits and investment, while kindling hopes of flowing through into higher wages for workers. Trade has long buttressed Japan's economic fortunes, a dynamic the BOJ is keen to nurture given stubbornly slow growth and entrenched deflationary psychology. As BOJ Governor Kazuo Ueda sternly warned in his latest remarks, failing to cement a virtuous cycle of rising corporate earnings, higher household income, and increased consumer spending would jeopardize the sustainability of the still fragile post-pandemic rebound. Yet the other side of the weak yen sword represents a looming threat of imported inflation, something the BOJ has spent decades fruitlessly battling through unprecedented monetary accommodation. While a moderate rise in import costs could arguably help jolt stagnant prices higher, a destabilizing inflationary spiral emanating from external sources like energy or food risks trapping the BOJ in an unenviable policy straitjacket. For now at least, Ueda and company appear sanguine about the net impact of the latest trade flows. I don't think this will have much impact on the BOJ's view that Japan's economy is recovering moderately, said Takashi Minami of Norinchukin Research Institute. But the biggest factor was a weak yen for both exports and imports. Indeed, beneath the headline numbers, the Ministry of Finance data revealed exports declined 5.2% in real volume terms, with the yen's slide versus the dollar to an average 159.77 in July juicing up the yen-denominated value despite flatlining quantities shipped abroad. In that sense, while the export growth registered in the latest data may appear optically robust, a significant portion of those gains stems from base effects and translational distortions rather than substantive increases in production or efficiencies captured by exporting firms. That said, there were some green shoots of an authentic turnaround in the report as well, especially from Japan's strategically vital automotive sector. Automakers ranging from behemoth Toyota to smaller players like Nissan have spent the past year embroiled in quality control scandals that undermined safety certifications and hampered production across various models. These missteps inflicted severe reputational scars on a Japanese industry famed for its fastidious manufacturing prowess and customer-centric ethos. Crippling supply chain bottlenecks only compounded matters further in the wake of COVID-induced factory shutdowns. However, the latest trade figures confirmed the simmering revival taking shape in this all-important export vertical. Toyota reported earlier this month that operating profits for its fiscal first quarter nearly doubled from a year earlier as the yen's sharp descent supercharged overseas earnings. Analysts now project record full-year net income for the automaking titan in the neighborhood of $18 billion. While a weakening currency has undoubtedly provided a healthy tailwind for Toyota's bottom line of late, the company and outside observers alike credit a slow but steady production rebound as the key driver of this unexpectedly strong performance. Vehicle shipments from Japan increased across all major destinations: the US, Europe, and Asia. Automobile production is recovering, but has not yet returned to previous levels, cautioned economist Chisato Oshiba of Daiichi Life Research Institute. She notes that even with the improved showing, demand itself is not strong due to a slowdown in overseas economies. Oshiba has a point: recoveries from supply shocks take time to fully materialize, especially when intersecting with souring global demand conditions. While Japan's exports to the U.S. maintained an encouraging 7.3% growth clip, shipments sank 5.3% to the sputtering European Union. And in an ominous sign, exports to China, long Japan's largest trading partner, flatlined at just 7.2% growth compared to the prior 12 months. With China's manufacturing sector in July contracting for the first time since 2022, fraying vigorous in the world's second-largest economy raises the specter of moderating demand for high-value Japanese inputs and capital equipment in the months ahead. Across the board, China has struggled to regain its economic footing in the wake of harsh COVID lockdowns and a rapidly deflating real estate bubble. While the communist leadership has implemented an array of stimulative fiscal and monetary measures, boosting external demand through measures like lowering taxes, these have yet to gain meaningful traction. As China's fortunes go, so too does demand for intermediate industrial inputs and investment goods from major exporters like Japan, Germany, and Korea. Any extended slowdown in China threatens to create a vicious cycle where weaker exports feed through into softer industrial production, stingier business investment, and ultimately lower household incomes in nations reliant on the Chinese end market. While external risks remain, signs are emerging that Japan's domestic economic engines may be revving higher as the nation finally puts its COVID struggles in the rearview mirror. Other government figures released earlier this month showed the economy expanded at a robust annualized 3.1% clip in the second quarter, marking the first positive print in 2 quarters. This return to growth was driven primarily by a surge in consumer spending, a welcome development for an economy long starved for robust household demand. Services activity like dining out and travel picked up notably as Japan rolled back its stringent pandemic restrictions. While this boost from reopening provided a healthy shot in the arm, it remains unclear whether the vigor will prove durable once pent-up demand is satiated. Persistent headwinds across major sectors like manufacturing and construction exerted a drag, as did net exports, which detracted from overall growth. Imports outpaced export growth, a byproduct of elevated energy costs that have bedeviled Japan's import bill. For policymakers at the Bank of Japan, this mixed bag highlights the fragility of the recovery and underscores the need to maintain a supportive policy stance despite the specter of imported inflation. In the bank's view, a temporary spike in import costs pales in comparison to the risks of abandoning stimulus too hastily and snuffing out Japan's long-elusive positive momentum. The BOJ remains firmly committed to its yield curve control program that explicitly caps long-term interest rates until wages and consumer prices exhibit sustained increases. However, this conviction has come under withering criticism from some corners given the distortions it imposes on Japanese bond markets. Indeed, the very act of reiterating the bank's dovish policy bias during Governor Ueda's first press conference on July 31 sent global financial shockwaves, reverberating from Tokyo to Wall Street. Bond vigilantes interpreted Ueda's remarks as dashing hopes that the BOJ would swiftly move towards normalizing its policies, triggering a tsunami of fixed income selling that sent bond yields spiraling higher worldwide. The repercussions were particularly severe across Japanese government bond, JGB, markets, with 10-year yields nearly tripling before the BOJ engaged in aggressive bond purchasing operations to restore order. At one point, yields on 20-year JGBs breached the bank's 0.5% cap, an unthinkable incursion into what was supposed to be a tightly controlled policy corridor. These violent market spasms left Ueda visibly shaken in the aftermath, with the newly installed governor forced to quickly walk back any insinuation that an imminent pivot towards tighter money was forthcoming. In a hastily arranged statement, he reaffirmed the BOJ's commitment to rock-bottom interest rates until consumer inflation is restored to its long-standing 2% target in a sustainable manner. Ueda's clear communication succeeded in quelling market jitters and stabilizing bond markets for the time being. However, the ordeal provided a jarring glimpse at the tightrope the BOJ must traverse between sparking a durable reflationary cycle and avoiding destabilizing financial volatility that could derail the recovery before it fully takes root. The balancing act grows more precarious by the day given the still widening gulf between the BOJ's ultra-dovish policy trajectory and its global peers who are aggressively ratcheting rates higher. With the Federal Reserve, European Central Bank, and others embracing restrictive policy to squelch inflation. Yield differentials have increased the incentives for global capital to flow out of Japan in search of higher returns. This has exacerbated downward pressure on the yen at a most inopportune time for import-dependent Japan. While a cheaper currency boosts export competitiveness in the near term, the inflationary consequences of higher import prices could force the BOJ's hand in ways that destabilize bond markets and overall financial conditions. Muddying the waters further, recent labor market data has sent mixed signals regarding the existence of substantive reflationary pressures that would warrant a hawkish pivot from the BOJ. Job openings remain elevated, but wage growth continues to undershoot the bank's targets, suggesting a still elusive feedback loop from corporate profits to compensation. In the BOJ's view, a virtuous cycle of rising wages and consumer prices must firmly take root before it can responsibly begin withdrawing historic monetary accommodation. Until then, it appears poised to hold the line on yield curve control and ultra-low interest rates irrespective of global bond market gyrations. We absolutely do not think the economic and price situation are now in a state that justifies considering higher interest rates, BOJ board member Naoki Tamura emphatically stated in a policy speech earlier this month. The bank remains resolute to sustain monetary easing. For veteran Japan observers accustomed to the country's decades-long struggle with insipid growth and deflationary stagnation, this steadfast commitment to super-loose money comes as little surprise. Faced with a tottering recovery, lingering supply shocks, a stubbornly strong yen, and the omnipresent existential headwinds of a rapidly aging, shrinking population, the BOJ has little incentive to sacrifice its reflationary ambitions prematurely. Yet even by the standards of a central bank that has embraced unorthodox policy impulses, the BOJ's present course places it squarely at odds with counterparts worldwide that have not only dialed back crisis-era stimulus but embarked on some of the most aggressive monetary tightening cycles in decades. Defying global norms has become something of a trademark for the BOJ under the leadership of former Governor Haruhiko Kuroda, who spent much of the past decade sailing against prevailing policy tides. As other central banks embraced normalized, conventional policies in the wake of the Great Recession, the BOJ plunged ever deeper into the unconventional realm. In addition to pinning short-term interest rates at -0.1%, Kuroda engineered an extensive asset purchase program that gobbled up massive quantities of government bonds and equity ETFs. He went so far as to impose an explicit cap on 10-year JGB yields in 2016 that was steadfastly defended through unlimited bond buying. These measures sought to hold down borrowing costs across the economy to combat Japan's persistent disinflationary malaise and incentivize consumers and businesses to spend rather than save. By subjecting bond investors to negative yields, the BOJ aimed to undermine the economic incentives to hoard cash, a behavioral phenomenon that had long stymied the bank's efforts to generate sustainable inflation. While hardly a panacea, Kuroda's shock and awe tactics moved the deflationary needle further than many predicted. After spending the better part of 2 decades with consumer prices locked in a disinflationary vice grip, Japan has recorded 14 consecutive months of positive inflation as of the latest June readings. To be sure, at just 3.3% year-over-year, inflation remains relatively contained compared to the specters haunting other advanced economies like the US or Eurozone. And given the outsized role played by volatile food and energy components, the BOJ rightly questions whether such price pressures will prove durable once supply shocks and base effects filter through. Still, after battling economic stagnation and grinding deflation for the better part of 3 decades, the simple reality of positive inflation prints represents notable progress in the eyes of BOJ leadership. A run of 2% or higher inflation seemed unthinkable not long ago. Governor Ueda has made clear he aims to build upon this momentum rather than short-circuit it prematurely with tighter monetary policy. In his view, ripping away accommodation risks reversing the fragile reflationary tailwinds before they manifest in the holy grail for central bankers. Broad-based wage increases that spark an autonomous, sustainable cycle of higher household income translating into increased consumer spending. We want to see firm increases in wages and a situation where companies can raise prices with confidence that higher wages will allow households to increase spending, Ueda remarked at his inaugural policy confab. We're not there yet. Absent such a durable feedback loop, the BOJ worries that simply stoking import prices through yen devaluation could backfire and diminish spending power for households already whipsawed by elevated costs for basics like food, energy, and housing. It's a delicate dance, to be sure. While the benefits of a cheaper currency provide some counterweight against rising living costs, Eroding purchasing power is the last thing an economy still struggling to revive demand needs. Undergirding the BOJ's caution is its sobering assessment of Japan's daunting demographic arithmetic that has steadfastly resisted bouts of fiscal and monetary stimulus over recent decades. With one of the world's lowest fertility rates and a rapidly aging population, the nation faces crippling structural headwinds that monetary policy alone is unlikely to outmaneuver. According to recent government projections, Japan's population is poised to shrink nearly 30% from current levels by 2070. Over that same period, the elderly cohort aged 65 and up will swell from around 30% today to nearly 40% of the total populace. Basic laws of compounding suggest this graying wave will exert a tremendous drag on economic vitality and growth potential. For working-age Japanese shouldering an ever greater tax burden to support swelling ranks of retirees, the impacts could be devastating. Reduced disposable income would likely translate into depressed consumption and business investment, feeding into a self-reinforcing cycle of weaker economic expansion and lower government revenues with which to sustain an already stretched social safety net. In this light, persistently anemic inflation may simply reflect the reality of a rapidly aging society with proportionally fewer income earners and families underpinning aggregate demand. Attempting to overheat the economic engine through excessive monetary or fiscal stimulus risks damaging inefficiencies and distortions. BOJ officials acknowledge that demographic currents are poised to exert mounting deflationary pressures that could swamp central bank policies oriented towards achieving and sustaining 2% inflation over the long run. Inflation today may persist for a spell given lingering supply-side frictions, but basic demand/supply dynamics portend an inexorable return to disinflation if left unaddressed. With its limited monetary toolkit, the BOJ can do little to directly alleviate birth rate shortfalls that represent the root cause of Japan's demographic quagmire. Those levers reside in the hands of elected policymakers who must divine ways to incentivize larger family formation. Some proposals under consideration include enhanced childcare support, generous parental leave policies, and government-subsidized fertility treatments. Yet efforts at the national level to date have yielded disappointing results, a reality that underscores the cultural forces inhibiting decisions to have children despite such public assistance. With the fertility horse having long escaped the proverbial barn, some economists highlight the imperative for Japan to alleviate its demographic strains through robust efforts to boost productivity via automation and digitization. Robotics, artificial intelligence, and other advanced technologies may represent Japan's best path forward to sustain economic vitality in the face of a rapidly shrinking labor force. By augmenting and ultimately replacing human labor with automation across sectors, a robot revolution could theoretically generate the productivity gains necessary to power GDP expansion even as the worker population contracts. Japan is well positioned to lead such a technological charge given its dominance in fields like industrial robotics, semiconductor manufacturing, and precision machinery. Corporate behemoths like Fanuc, Yaskawa Electric, and Kawasaki are among the world's preeminent automation suppliers. Yet transitioning to a robot-powered economy is fraught with complications, both economic and social. While automation could boost productivity and support income levels, it would also hollow out wide swaths of the labor force traditionally employed in fields ripe for automation like manufacturing, logistics, and transportation. The resulting societal disruptions could be immense, unleashing waves of worker displacements that exacerbate income inequality and strain government safety nets. Over-reliance on automation could also exacerbate demographic pressures by reducing the incentives for childbearing if household formation and raising families becomes unaffordable amidst stagnant wages. As such, any robot-driven economic reinvention would necessitate a comprehensive policy framework that smooths the distributional impacts through mechanisms like worker retraining programs, portable benefits that transcend individual employers, and bolstered social insurance backstops. Forging such a regime would likely require deft political leadership and cooperation across business, labor, and government spheres. For better or worse, Japan's policymakers cannot escape the cold reality that difficult trade-offs likely await down any prescribed path forward. Simply muddling along while layering stopgap monetary and fiscal stimulus atop existing demographic dynamics appears increasingly untenable. In a sense, the nation finds itself at an inflection point where choosing to pursue aggressive productivity-enhancing reforms like increased automation and industrial digitization may be one of the few remaining options to arrest, or at least delay, its seemingly inexorable slide into economic stagnation. Skeptics counter that Japan has heard such calls for revitalization before, only to be continually stymied by vested interests, bureaucratic inertia, and the sheer enormity of the challenges involved in overhauling entrenched economic and social models. After all, this is a nation that has spent the better part of 3 decades desperately attempting to rekindle the halcyon days of rapid growth and global preeminence that defined its economic miracle from the 1960s through 1980s. Grand visions like former Prime Minister Shinzo Abe's ambitious Abenomics program, aimed at remaking Japan through structural economic reforms, ultimately sputtered out incomplete. Whether Prime Minister Fumio Kishida's latest policy platform focused on economic security, human capital investment, and productivity enhancement can succeed where others fell short remains to be seen. Critics already bemoan a lack of specifics and accuse the premier of simply repackaging prior reform rhetoric into new branding. If the road ahead appears fraught for BOJ Governor Ueda and the central bank's guardians, potential paths forward look no less treacherous for the nation's fiscal stewards. Already saddled with a public debt load exceeding 260% of GDP, the highest among developed economies, Japan's budgetary decision-makers must deftly navigate a minefield to resuscitate economic dynamism. Unchecked spending could risk sparking a destabilizing spiral of higher borrowing costs that chokes off any reflationary momentum. Tokyo has largely placated bond market skeptics through policies like the BOJ's yield curve control program and the home bias of domestic investors who absorb the bulk of JGB issuance. But with interest rates set to rise globally, the allure of better returns abroad may test investor patience with Japan's profligate fiscal stance. The Kishida administration has signaled its intent to pair increased social spending aimed at boosting family formation and human capital development with tax measures intended to catalyze increased business investment in automation and capital deepening. Ambitions also appear focused on leveraging public works funding to fortify domestic supply chains and enhance economic security through steps like reshoring semiconductor production and bolstering energy infrastructure. Realizing these agenda items will require deft fiscal maneuvering to walk a tightrope of sustaining economic support while stabilizing Japan's precarious debt dynamics over the longer run. With limited capacity to embrace bold demand-side stimulus given existing debt loads, policymakers appear oriented towards pursuing supply-side reforms that can theoretically boost long-term growth potential without excessive borrowing. Yet even here, challenges abound. Attempts to raise tax revenue through higher levies on corporations and wealthy individuals risk damaging the investment and entrepreneurship necessary to drive sustained productivity gains. Similarly, rolling back the nation's generous social benefits could stoke unrest and corrode domestic demand at a time when policymakers should be prioritizing initiatives to bolster household formation and reverse demographic declines. Prime Minister Kishida's policy blueprint aims to finesse such tensions through gradualism, implementing moderate fiscal tightening over time while directing spending towards areas that can enhance economic vitality like education, healthcare, and next-generation infrastructure. Supplemental tax incentives and deregulation are envisioned to spur private capital towards technologies that augment a shrinking labor force. Yet this incrementalist approach has drawn criticism from those viewing Japan's predicament as too acute to remedy through piecemeal tinkering around the edges. More hardline reformers have renewed calls for aggressive debt reduction through expenditure slashing, privatization of public services, and perhaps most controversially, raising Japan's consumption tax rate, which at 10% remains well below levels in most other OECD nations. Pursuing such austerity could well choke off the very economic revival Kishida and fiscal policymakers are aiming to ignite. However, kicking the proverbial can down the road too far also risks a destabilizing day of reckoning with bond markets increasingly skeptical of Japan's fiscal sustainability. Walking this fiscal tightrope is further complicated by intensifying demographic realities that are poised to rapidly outpace even the most ambitious attempts to goose productivity and labor force participation. Over the coming decades, rising outlays for pension and healthcare benefits supporting a rapidly graying society will mushroom by an estimated 3 to 4% of GDP annually according to government forecasts. Simply treading water fiscally would require complementary measures like tax increases that could sap economic vitality. Hence the conundrum, bold actions to enhance growth through privatization and austerity seem counterproductive if they end up retarding consumer demand and business investment. Yet avoiding tough fiscal medicine altogether is a path towards ballooning debt service costs that will increasingly crowd out productive spending and investments vital to revitalizing long-term growth. As if this dual policy quagmire spanning monetary and fiscal spheres wasn't daunting enough, Japan's economic stewards must also contend with external forces poised to further constrain the nation's running room in the years ahead. The simmering revival in Japan's export engine detailed in the latest trade figures masks deeper structural currents that could severely hamper these industries over time. Escalating geopolitical frictions, rapid technological disruptions, and a concerted global policy pivot towards reducing carbon emissions all threaten key pillars of Japan's traditional export juggernaut. Start with the automotive industry, whose rebound was a bright spot in the July trade report. Long a source of immense pride, Japan's automakers face intensifying headwinds from tightening emissions regulations worldwide that favor a shift towards electric vehicles, EVs. To date, Japan has remained anchored to the internal combustion engine and hybrid technologies its manufacturers pioneered, but that leadership posture appears increasingly tenuous as other nations like China and Europe throw regulatory policies behind accelerating EV adoption. Japanese automakers like Toyota have certainly joined the electric revolution with their own battery-powered offerings. However, by most accounts they remain well behind leaders in the EV space when it comes to dedicating capital expenditures, supply chain build-outs, and model development roadmaps for the technologies poised to dominate the industry's future. Legacy commitments to existing production infrastructure and internal combustion architectures likely contributed to this relative hesitancy to fully embrace EVs. So too has Toyota's belief that alternative technologies like hydrogen fuel cells may ultimately prove more commercially scalable and environmentally sustainable than lithium batteries. However, as climate change imperatives mount and other nations double down on battery technology through measures like production incentives and EV purchase subsidies, Japan could find its automotive export crown increasingly challenged in key markets. Further erosion of domestic gasoline-powered vehicle demand could leave Japanese firms flat-footed in the transition.